All right, let me kick this off. So Dave Weisberger is the CEO and founder of CoinRoutes. And this is a really interesting kind of part of the market as well. Dave's going to give kind of a solo presentation for probably about 20 minutes, 15, 20 minutes about trading and how to execute and algorithmic kind of best execution, portfolio management tools. This was a dearth a void in the industry several years ago, particularly when we were launching our fund. And all the things that traders, investors, fund managers took for granted in traditional markets and equities, for example, literally didn't exist in the world of crypto. So Dave is one of the kind of pioneers of building the tools that we all need to exist. And he's going to talk a little bit about what that looks like. He's got a really long, extensive background in the world of traditional markets, market structure, quantitative finance, automation of trading, kind of in traditional finance, Wall Street, and other things that I'm sure he'll be thrilled to tell you all about. So let me turn the floor over to Dave and take it away. But I'll jump back in when we're going to wrap up. Probably does 20 minutes sound about right?
That's fine. I mean, I'd like to leave time for questions in the chat, so we'll see. And I'm happy to answer things as they go. The most important thing to keep in mind about me is while I may very well have been in the business for 30 plus years, I kind of feel like I reinvented myself about 3 years ago when we started at CoinRoutes. And so understanding crypto market structure from the ground up is sort of our mantra, and understanding best execution is really important. So what we're trying to do is to understand today, or just talk about what do we mean by best execution, and then we'll go through some data. We'll talk about some of the myths that exist in the industry and some implications for trading. I want to start, however, with what Alex was talking about right at the end of the last panel, because that is the key. He was talking about how the critical nature of doing custody well is to allow funds to make alpha, i.e. generate performance for their investors. Well, best execution quite literally is precisely that. Just a little story. When I was at 2 Sigma, and I was like employee 240 in the company, so I had nothing to do with founding it. And it's now over 2,000 people. But I spent a good 5+ years there, and I found out that one of the first half dozen employees in the firm was hired to spearhead execution research, because they knew something very important, something that firms like Rentech and Millennium and others have figured out, which is that if you identify opportunities but don't capture those opportunities by trading them well, you're not likely to succeed. And best execution is quite literally the ability to buy or sell what you want to buy or sell at the lowest or highest possible price. Obviously, buy low, sell high. The thing about best execution is really interesting, though, is that there are a lot of variables, and people like to say how difficult it is to measure. So most people define best execution in terms of a trading process. So it's not that you can say, on this trade, I did the best thing. It's that I have a process which will allow me to do well, and will also allow me to understand what is the appropriate amount that I can afford to buy of a particular asset. Now, in crypto, and you're buying Bitcoin, most of the time, it's not like you can size your Bitcoin position that easily. There, you'll end up using things like leverage and other things to associate it with it. But in general, it's about trying to keep things to a minimum, and we'll talk about what that means. But the variables that really influence the trading process are things like the bid offer spread. What does it cost to, if someone wants to sell immediately or buy? That spread is real, and trying to minimize that spread for the size that you're trying to trade is very important. In crypto, fees are incredibly important, and we'll talk about the data there, but far more than in other asset classes, fees, particularly from exchanges, are very, very relevant. The next major thing, which is incredibly important in crypto, is market impact, which is really how much it moves, the asset moves from the beginning to the end of trade. I can't say I'm incredulous, because I was doing program trading in Japan in the 90s and helped build systems there where we saw routinely 10 or 20% moves in the market, particularly around futures expirations. But the fact is there's more vertical lines in Bitcoin's chart than almost any other asset class until, of course, this past March. So at the end of the day, a lot of that has to do with, quite frankly, dumb trading. And we'll talk about some of what that means later. And lastly, opportunity cost. If you wait too long or if you're trying to be too patient, that could be painful. So you really do have to participate with the market. So let's talk about what do we mean by trading process. Well, trading can be as simple as I'm just going to pick up the phone. I'm going to use a Telegram channel. I'm going to go on Skype. I'm going to call one dealer. I'm going to agree or buy to sell based on the price he quotes me. I wash my hands about it. I'm done. And I wait for Bitcoin to go to the moon. Believe me, that is not an unpopular method of trading. And it's not necessarily a bad one if you pick the right dealer. Uh, of course, who is the right dealer really depends on what point in time it is during the day. But at the end of the day, it is a perfectly reasonable thing to do. Another thing that is perfectly reasonable is to give an order to an agent, someone you trust, who can work that order for you and let them decide where, when, and how to trade. So that's the simplest thing from a trading perspective. The complexity can be trading on several exchanges simultaneously, comparing quotes with those provided you by dealers, and deciding if I'm working 1,000 Bitcoin order to buy or sell, where to trade 20 here, 100 here, 5 here, etc., and doing that yourself. There are people who try to do that, and there are people who do their other trades on themselves. So that's the ends of the spectrum, as it were. So what are poor trading processes? So now I'm going to insult people. I apologize for those who I am insulting. I'm happy to teach. I like to talk about this stuff. But at the end of the day, there are certain things that are done often in the world of crypto that, quite frankly, are just universally dumb. And dumb means it's going to move the price a lot and you're going to get a bad outcome. You're going to buy and you're going to pay a lot too much, or you're going to sell and you're going to knock the price down before you get to sell it. So what's the first thing you should never do? Well, you shouldn't call multiple dealers and request a quote at the same time for a large order, or place the entire order on an exchange where the public can see it. So there have been examples, we've seen them. 5,000 market, share, 5,000 Bitcoin or 4,000 Bitcoin to sell at market on a particular exchange, triggering $1,000 drop. That's something we have absolutely seen. We have seen multiple spikes where someone gets the idea, oh my God, there's a big buyer looking for an offer, the price ramps, or there's a big seller looking for a bid and the price drops. These are things that happen before the trade is generally consummated. That's why I call those a poor idea. It's because it creates market impact. The other thing that's generally a bad idea to do is trading manually in individual exchanges when you break the order up by hand. Exchange prices diverge, and they diverge very, very quickly, and they converge again. And it makes it impossible for manual trading to be optimal. It just is. It's sort of like, I used to make the joke because people are always afraid of technology. And I said, well, what would happen? This was on a panel that I did years ago in front of a bunch of equity people, and they were talking about algorithms. They can't trust them. And I said, well, let me ask you a question. If you got on an airplane and the pilot said, excuse me, I just want to let you know that I have 25 years of experience flying, and I don't trust modern technology. So I'm going to turn off all the avionics on the plane. I'm going to turn off all the safety systems, etc. My question was, would you stay on the plane? I know I would have gotten the hell off, and most people would. The point is there are certain things computers do better. Trading is definitely one of them at the knife edge of order placement. So let's talk about data. We're going to talk about it in 3 different types of things. We're going to look at the fees versus spreads. We're going to talk about full depth of order book, and we're going to measure fragmentation and mean reversion and take a look at it. And then we'll compare some of the costs. So what are the fees to spreads? Now, you don't have to read the whole chart. I just happen to pick 6 exchanges and look through them. And what's really important to understand is on the high end, you have the fee spread ratio is very important. Coinbase Pro, their fees for what is a reasonably large institutional customer, but not an incredibly active trader like a market maker, can be 11 times, more than 11 times the actual spread on the exchanges. In the case of Bitstamp, their fees can actually be about the same as the spread. So it does vary. But what's really important to understand is that in no other asset class are fees ever larger than the tick size, whereas in crypto, the tick size, which is a penny in Bitcoin, the fees are quite often over 100 times that tick size. So this has significant meaning in terms of what's going on. Now, to fill out the rest of this data that's kind of interesting is you also should look at the difference between the cost of taking liquidity, which for those of you who aren't familiar with how it works, it means I see an offer at 96.90 well, let's see, what is it at now? 96.70 or 96.80. I see an offer and I just want to take it. I want to get it done right then and there. Or making where it says, you know what, I'm going to bid a little below that and let someone, hit my bid. And maybe I get filled, maybe I don't. One is maker, that's when you place passively. When you're aggressive, it's called taking. And you can see that there's some big differences there. This creates some very important things that are worth understanding. But let's talk about, what does this data really mean? Well, it means fees are a driver of trading costs, and they're significant drivers. So you need to be aware of them. One of the big benefits of trading OTC is the OTC brokers generally eat the fees that they're using to trade out of the positions, and you don't have to pay them. And that can very often mean that the OTC quote is better than exchange quotes. Maybe often it's not true, but it varies. But bid offer spreads on exchanges vary, and they're generally between 1 and 6 basis points on their top of their book, but it's not for that much. It's for, on average, around a Bitcoin. It can vary. It can be as much as 15 or 20. It can be less, etc. If you were watching earlier, Ambra Keiko was talking about the cost of trading to depth on individual exchanges, and we're going to see that in a second. Actually, if you look at a consolidated view, it's generally a lot less expensive than she was talking about. But it is important to understand that when you trade on exchanges, it's for small bits. To put this in perspective, at my firm, we've traded, we're getting close to $2 billion worth of trading, but we have sent well over 1 million individual orders to exchanges over that time period. And that's kind of important when you consider that the average trade size we have is over $50,000 a trade. So there's lots of order placement going on. The other big thing that's important to understand is that fee differential between maker and taker. It's an important reason why we believe that smart order routing, unlike in traditional finance, which is mostly taking liquidity, is actually, should be, if you want to be smart, actually passive, placing orders. Excuse me. So now, let's look at some facts about the consolidated order book. So this is a statistic for buying or selling 1,000 Bitcoin. I actually did it yesterday on a Sunday afternoon. So if anything, this is understating, or kind of, understates that the market is generally more liquid than this. But at the time that I did this, the best bid, and you can see we've rallied since then, the best bid was around 9,500. What's interesting is you could have sold 1,000 Bitcoin like that by taking liquidity at 94.53. To do that, however, you needed to be able to look through and access over 553 individual price levels. Now, that's not how many orders had to be sent, but that's how many individual levels that there were on the exchanges that I was looking at. What this is telling you is, on a gross basis, essentially $9 million plus of Bitcoin, you could have sold for 33 basis points, which is a crazy low number compared to some of the things that a lot of people have been told. And even net of exchange fees, which are based on, an average kind of institutional sized order, not a market maker, it would be less than 50 basis points. And on the buy side, at the time, it was actually a little bit cheaper. And so you can see that once again. But what this is telling you is that within fairly close to the market, in a reasonable amount, to have an understanding what the order book looks like in Bitcoin, you needed to look through over 1,000 price levels. Now that's really different, because if you compare that to other markets usually 5 or 10 price levels has all the liquidity that people care about. So when you want to understand, or you want to evaluate a trading system, or understand people who are working for you, if you can't see in real time 1,000 price levels, you're probably more or less blind to what's going on in the book and how to trade. I also, just for comparison's sake, ran what it would be for 2,500 Bitcoin, so almost a $25 million trade. And here it gets really interesting, because you see that the number of executions that you would have to look at. Whoops, I want to go backwards. Let's see, can we make this go backwards? Yeah, just for execution's sake, we at CoinRats actually, in this particular case, looked at over 2,000 price levels on the sell, and on the buy at 1,500, so 3,500 price levels. I mean, we're actually tracking in the neighborhood of 30 or 40,000 price levels in real time, but that's not terribly important. A lot of that stuff is bids for a penny and offers for 1 million, so it doesn't really matter that much. But what's here is you could see that even for 2,500 Bitcoin on the wire, you could get it traded for around 1.5%, or less in the case of buying, because at this particular time it was easier to buy than to sell. So lots of interesting implications about that. What do we mean from this? Well, the first is that the exchange liquidity is quite robust and potentially quite cost effective. The narrative for institutions is they need to trade OTC. The answer is no, they don't need to trade OTC. They want to. Now, there's a reason for this. The reason is because on exchanges, they have to pre-fund their position. In equities, if you want to trade on NASDAQ, New York, BATS, Edge, doesn't matter which exchange you're trading on, and there are quite a few of them. You don't have to pre-fund. They just have central counterparty clearing. But since every exchange at this point makes you pre-fund on that exchange, you would have to have treasury management. And there are firms out there that help deal with that in a variety of ways. I'm not going to talk about that now, but that's one of the reasons that OTC dealers are really shine. But that said, there's a lot of liquidity on exchanges. And so if you are willing to do that and you're willing to trade that way or trade through someone who is doing it that way, you can find a lot. The second is to see the exchange liquidity, you have to evaluate at least 1,000 and probably thousands of price levels. So it's a totally different data structure. Any software that was built for FX or equities that was ported over to crypto is not going to work. It's going to need to be severely changed because it needs to be purpose built to handle this particular thing. The next thing to keep in mind is that beyond a couple thousand Bitcoin, liquidity really starts to thin out. And you can see that by the rate of change. And if I showed you 5,000 Bitcoin, you would see it. This puts a premium sometimes when you're on orders on patience. And so you do need to understand how you're doing it and what can be done. Now, the reality is that the data shows that patience outperforms on small orders too, in many cases. But for large orders, it's particularly important. Okay. The third part of data that's interesting is exchange variance. And this graph, and we do these graphs all the time in different ways. This was just one day, and it looks, and you can see the blue is the best bid and the orange is the best offer. And if it looks strange to you, it's not. Most of the time, the best bid is higher than the best offer across exchanges. But what's really interesting is how incredibly often they revolve around each other. What we call this statistically mean reversion. And so that tells you that if you're trading on one exchange, it's okay. But you should understand, always know where that exchange is, because if they're higher than the other ones and you're buying, you want to wait. If they're higher than the other ones and you're selling, you want to be very aggressive, and so on. So it's not just about trading on multiple exchanges. It's about knowing where the exchange you're trading on is within within it. So what does all this say? There are a few myths out there that I hear a lot. One, crypto market structure is just like other electronic markets. Well, no, not true. Fees relative to spreads, the importance of depth, fragmentation, it makes it very, very different. I've gone through a bunch of that. Second, most Bitcoin liquidity is OTC and originates OTC. No. OTC dealers provide incredibly valuable service by taking risk and providing immediacy, by allowing people not to have to do treasury management, etc. And quite often they can have two sides of the trade and match it. But much of the liquidity, quite a bit of it, is trading on exchanges. And most of the OTC dealers, the really good ones, are some of the largest clients of the exchanges. So that's important. Last, smart order routing is easy. Just take the best price. I can't tell you. There's YouTube videos out there from people who say, we could do really good with smart order routing. And they're talking about just getting the best price among a group of exchanges. And, you can do that, and that's fine, but it doesn't perform as well. So what does this mean for trading and trading technology? Well, the first is always be aware of the relative trading cost, when and where liquidity is available at any instant in time. You should demand liquidity when you need to. If you need immediate execution, and there are many strategies which are based on short-term signals, then it's reasonable to pay for it. Otherwise, the market is generally better for liquidity providers, being patient and working orders. Data access while trading is critical. Even if you're trading on a single venue, your order placement needs to be informed by a consolidated view of the market. So here's the commercial. I hate commercials in these things. I really just want to tell people, but this is the deal. The fact is the money is proven by the money shot, which is when we look at our performance, we are delivering somewhere less than 2 basis points of slippage from a consolidated midpoint price on hundreds of millions of dollars of orders through our system. That compares to smart order routing would be slippage of somewhere north of 20 basis points net of fees, and single exchange routing significantly greater than that. So it's a big difference. Now there are many dealers that can get you similar things, but not all the time, and that's kind of the point. To give you an idea of this, this is what our technology looks like. And if you look on the right side, I'm looking at Ether. Let's look at Bitcoin as people like to see it. You can see that right now, there's a couple of market makers who are in here. And as you watch, there will be plenty of times when market makers, and Max from B2C2 wants to make, is streaming to us his top of book. You will see quite often they are a better net of fee deal on one side or the other. And that's really important to know. But if you watch this like I do, you will see that, and with apologies to Coinbase Pro, GDAX is what we started with it, and we never bothered changing it. But you will see that there's an incredible rotation for who's on the best bid, who's on the best offer during every one of these moves and candles. So with that, I will stop and see. I can't look if there are any questions, or if not, I can take some, or I could keep talking. But I think I'm more or less.
Dave, that was a very admirable and efficient overview for everybody, and engaging, I should add. Hope everyone found it helpful. Any questions?
Uh-oh. Is he trading bots? People ask about trading bots all the time. It depends what you're trying to do. I say there's a question about trading bots. We answer the question, if I want to buy in the next minute, hour, day, what's the best way to do it? The fact of the matter is that in our situation, what we've done is we've created lots of parameters for people, and we've also given the stock answers for people. A lot of trading bots are trying to do arbitrage or just generate income. That's a different answer. We're trying to provide tools for investment managers. So people like Matthew's firm, if they're trying to buy an altcoin, or if they're trying to buy on spot exchanges, we can get them a better price because they know what they want to do for their investors. That's different. We are not answering the what to buy question. We're answering the time, place, and manner of how to go about buying or selling. That's the difference. Most trading bots are really trying to be a prop strategy. Now, I've spent 10 years of my life building prop strategies, and I can tell you there's a difference between the two. So we're kind of at the knife edge at the end. And firms like Tagomi are in the same boat, which was just bought by Coinbase. We look at the world the same way.
Dave, this was great. I think I can speak for everyone. And for everyone who did tune in, his name is Dave, not question mark. And the company is CoinRoutes, and the URL is www.coinroutes.com.
Yep.
So really appreciate your time, Dave, and your expertise and everything you're doing in the industry.
Thanks, Matthew. Sorry about the question mark stuff.
No worries.